gold was almost exactly the same return as the S&P 500 was, maybe a little bit better, but it was right on the money. I mean, and people think about that and they think, well, if I bought gold alongside the S&P 500 in 24, we'd have made the same amount of money. And we would never buy that much gold. But I have to think that, and I've watched this with individuals, they've been selling the exchange traded funds that hold gold. They've been selling them. They're leaving, okay? But if you look at the foreign countries, they're buying. They're buying gold and they're adding gold to their coffers. I think they're adding it because of the dollar. They don't want to be tied as much to the dollar, but they're buying it, all these other countries. And so I think there'll be a demand there for it.
Recent trends in the gold market reveal a complex interplay between institutional investors, global central banks, and Asian buyers, culminating in record-breaking performance during 2024. The precious metal demonstrated remarkable strength, posting a 29.3% gain and outperforming major stock market indices while reaching unprecedented price levels. December 2024 marked a significant shift in gold ETF dynamics, with inflows reaching $778 million, the first positive December flow since 2019. This contributed to total net inflows of $3.4 billion throughout 2024, pushing assets under management to a historic high of $271 billion. The positive December performance was noteworthy as it followed November's temporary dip, representing the first negative flow since April. Asian markets emerged as the primary drivers of this growth, contributing $748 million of December's total inflows. This regional strength aligns with broader trends, as Asian buyers, particularly from China, continue to play a pivotal role in supporting gold prices. Senior analyst TedOakley emphasizes gold's historical resilience during economic downturns, citing its strong recovery following the 2008 financial crisis as evidence of its effectiveness as a hedge against market instability. This perspective gains additional relevance as foreign nations increase their gold reserves, potentially signaling efforts to diversify away from U.S. dollar-denominated assets. Looking ahead, market analysts suggest gold has entered a bullish consolidation phase, though they caution about possible near-term corrections before the metal potentially advances toward new highs of $2,790. Interestingly, recent positive economic data from China, including better-than-expected Q4 2024 GDP growth of 5.4%, and strong retail sales and industrial production figures, has had limited impact on gold prices. This is particularly noteworthy given China's position as the world's largest gold consumer. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
Well, people probably don't realize this, but gold was almost exactly the same return as the S&P 500 was. Maybe a little bit better, but it was right on the money. I mean, and people think about that and they think, well, if I bought gold alongside the S&P 500 in 24, we'd have made the same amount of money. And we would never buy that much gold. But I have to think that, and I've watched this with individuals, they've been selling the exchange traded funds that hold gold. They've been selling them. They're leaving, okay? But if you look at the foreign countries, they're buying. They're buying gold and they're adding gold to their coffers. I think they're adding it because of the dollar. They don't want to be tied as much to the dollar, but they're buying it, all these other countries. And so I think there'll be a demand there for it. And gold itself, if you remember, I'll just use '08 as an example. It went down. It didn't go down until the end, but it went down. But it came right back, came back about as fast as anything did in '09. And so I think gold itself will have a pretty good, and a lot of that goes back to, again, what do you want to own? If they get into trouble, this financing thing, I'm talking about what we've got coming due, and I could go into that, but we have so much money coming due that we've got to finance in the U.S. government, okay, that if they get into trouble and do that financing the wrong way, and we'll see what happens, gold will probably be the one thing that does hang in there. We'll have to see how it goes, but I think that's the problem they're running into. You got to remember, right now, we're in a situation where just tax receipts alone go to really pay down just the interest and a little bit of the debt. I mean, we don't have any other room. We're debted up right now, 120% of GDP, government debt. So we have so much money. What happened was, under Treasury Secretary Yellen, she basically quit buying long paper, or selling long bonds. I shouldn't say buying, but selling long paper. I'm talking about 30-year paper. The reason being, because I personally think it was political, that they didn't want interest rates to go up, okay, on the long end, because that would cause a lot of trouble. And so they sold everything they sold, a lot of were just treasury bills, like 90-day, 6 month, few 9 months. That got sold instead. So this year and next year, between 24, 25, and 26, you have 15 trillion of that coming due. Okay. All right. Well, you got to refinance that. And when you go to refinance that, you have to remember that that's called a hedge on what they do on the dollar. Like if the dollar stays strong, a lot of foreign countries that have dollar denominated debt, they'll sell that stuff. They'll sell the bonds because they're like, hey, I got to pay off in dollars. So it creates a lot of downward pressure on the price, is what I'm saying. And maybe there's a way for them to get out of it. I'm sure eventually what will happen in the long, long run will be like it always does. We'll run inflation higher than what you can make with what the Fed will set the interest rate, but it'll be lower than inflation. And that's how you'll get out of this trap.
Recent economic data and expert analysis suggest that inflation pressures may prove more persistent than initially anticipated, despite moderate overall price growth during 2024. Consumer prices demonstrated significant momentum in December, recording the largest monthly increase in 9 months and highlighting ongoing inflationary challenges that align with the Federal Reserve's cautious stance on monetary policy adjustments. The Consumer Price Index data revealed a year-over-year increase of 2.9% in December, marking the highest annual rate since July and exceeding November's 2.7% reading. While the overall inflation rate for 2024 moderated to 2.9% from 4.1% in 2023, recent trends suggest this deceleration may be temporary. Senior analyst TedOakley provides a more hawkish outlook, suggesting that while temporary relief in inflation and interest rates might occur during economic slowdowns, these declines are unlikely to be sustained. His analysis points to a potential normalization of inflation around 4 to 4.25%, significantly above current levels and more aligned with historical patterns. Let's get back to the interview.
Inflation would now go to another level as opposed to where it's been. I mean, that period from really 2009 until 2022 was a very abnormal period. If you look back at the history of money, that's never happened. It only happened because of the way they did things, really.
Are you referring to the spike in M2 money supply?
No, I'm really referring to where we were in terms of really, really low inflation. If you look at the only thing you can use really is CPI or PPI, but that should be running now on normal, 3 to 4.5 or maybe 3 to 5. It's going to go back like it was. If you look at that period going all the way back to like 1960 or so, early 1960s, through the period, the end up to 90, you had a period there where the average was about 4 points or 4.25. And I think we'll go back to that. And if you go back to that, then inflation is going to be a factor here. And I think it'll be a bigger factor than people think it is. Maybe not in the short run. If things slow down, the economy breaks down, obviously it would fall back. But I'm just saying over a long period of time, 5 to 10 years, I think you've got to bet on inflation being higher and interest rates being higher. I think the bigger situation is going to be where you got a problem with the Federal Reserve has this problem. They are running into the problem of the U.S. government debt. Those two combined will be where you're going to have some sort of policy that addresses that, because I personally think that the long rates will go up, like you're almost at 5 today, right at 5 on the 30-year bond. I think they go up over 5 to 10 over this next decade, whether they lower rates or raise rates, either way. Well, I think the average person has to realize that we've said this all year long, you need to know what you own. And one of the things that we have espoused really, and it's really paid off for us over a period of time. It hurt us during the 2021 period. We had real short maturities, so we didn't make as much money, but it helped us because we never got hurt during the rise in interest rates. You got to keep your maturities short. If you're buying 20 and 30-year paper, I think you're making a wrong bet here for the next 10 years or 20 years. And that's just something that we feel like the average investor doesn't realize, but they're buying into bond funds that buy that long paper, and we just don't think that's where they should be. Well, I think it will come back to the monetary more than what we're looking at there on those sorts of things, because what happens eventually is we're at this level now where debt to GDP is 120%. And so you're in a situation where foreigners own a lot of our bonds, and they're probably going to sell those bonds because with the dollar going up, that means everything they owe money in dollars is hurting them. So they've got to make some adjustments. I think that affects the rates and what I'm saying. But I think that also works itself into where everything will have more inflation as you go up. Yeah, it's going to come and go. I mean, there's no question about that. And I've said all along that if you get short term down, and we thought you could get interest rates and inflation rates low in the short term. You could, because things might slow down enough to do that. If that happens, don't take the bait, is what we're saying, because it won't last. In our opinion, it won't last. We'll go back to normal, which should be, again, 4%, 4.25%. It should be higher than where it is now.
The evolving dynamics in the gold market reflect its enduring appeal as both a safe haven asset and a strategic investment amid global economic uncertainties. As inflationary pressures persist and geopolitical shifts reshape reserve strategies, gold's resilience highlights its critical role in diversified portfolios. While short-term corrections may occur, the underlying factors suggest a solid foundation for long-term growth, making this a pivotal moment for investors to reassess their positions in the precious metals market. How do you view the interplay of global economic trends and investor behavior shaping gold's trajectory in the coming years? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.